Your bank does not have your money. Not even close. Right now, your bank legally holds less than $1 for every $10 you deposited. And since March 2020, the Federal Reserve requires them to hold exactly zero. Zero reserve requirement. Your savings account is funded by debt. Your money is a legal fiction created by a spreadsheet entry. This is fractional reserve banking. Not a conspiracy theory. Federal Reserve policy. Publicly documented. Working exactly as designed. In the next 7 minutes, you will understand how banks legally create money out of thin air, why your $1,000 deposit becomes $10,000 in the economy, and what happens when everyone wants their money back at the same time. Spoiler: Silicon Valley Bank. Let's go. When you deposit $1,000, you think the bank stores your $1,000 in a vault somewhere. They don't. The bank records a liability to you. They owe you $1,000. Then they take most of that and loan it to someone else. That person deposits their loan at another bank. That bank loans most of it out again. Same dollar. Loaned out multiple times. This is not fraud. This is literally the business model. Banks make money on the spread between what they pay you in interest and what they charge borrowers. Your deposit is their raw material. You are a creditor of your bank, not a depositor in the traditional sense. That is the legal reality. Here is the exact mechanism. Historically, the reserve requirement was 10%. For every $100 deposited, banks kept 10 in reserve and lent out 90. That 90 gets deposited somewhere else. That bank keeps 9 and lends out 81. Then 72. Then 65. The math compounds through the entire banking system. $100 in actual cash becomes up to $1,000 in total deposits. A 10 times money multiplier. But here is the plot twist. In March 2020, the Federal Reserve reduced the reserve requirement to exactly 0%. American banks are now legally required to hold $0 in reserve against your deposits. Zero. The Fed said this was because banks already held excess reserves anyway. Make of that what you will. Let's make this concrete with real numbers. You deposit $1,000 at Bank A. Bank A loans $900 to Alice for a car. Alice's car dealer deposits $900 at Bank B. Bank B loans $810 to Bob for home renovation. Bob's contractor deposits $810 at Bank C. By the time this cycle completes, your original $1,000 has generated approximately $9,000 additional dollars in new deposits across the system. Total deposits in the economy, $10,000. Actual cash created by the government, $1,000. The other $9,000 exist only as accounting entries. Digital numbers in bank databases. This is how money is created in a modern economy. Not by printing presses. By loan officers clicking approve. Roughly 90 to 97% of money in the US and UK exists as bank deposits, not physical currency. The numbers are staggering. US M1 money supply in January 2020, $4 trillion. By January 2021, $18 trillion. A 400% increase in 12 months. The FDIC insures deposits up to $250,000 per account. There are 9,500 FDIC-insured banks in the U.S. Total insured deposits, approximately $10 trillion. Total FDIC reserve fund backing those deposits, $125 billion. That is 1.25 cents of insurance for every insured dollar. The math only works if not everyone asks for their money back at the same time. In 2023, Silicon Valley Bank proved what happens when they do. $42 billion in withdrawals in 10 hours. The bank had $209 billion in assets. It collapsed in one business day. This is not a bug. It is the feature. Fractional reserve banking is how economies scale credit. Without it, you could only borrow money that someone else had already saved. Economic growth would be capped by existing savings. With it, a bank funds your mortgage today using deposits that might not exist yet. It finances businesses before they generate revenue. Infrastructure before it generates tax income. Every major economy on Earth uses fractional reserve banking. It has existed in recognizable form since 17th century Amsterdam. Dutch merchants were doing this with gold receipts 400 years ago. The Bank of England formalized it in 1694. 330 years of this system. Not going anywhere. The risk is a bank run. If depositors lose confidence and all withdraw simultaneously, no bank survives. They do not have the cash. It happened in 1929 and triggered the Great Depression. It happened in 2008 with shadow banking instruments. It happened to Silicon Valley Bank on March 10, 2023. SVB held long-duration bonds that lost value when interest rates rose. Word spread on Twitter and in group chats. Depositors withdrew $42 billion in 10 hours. 93% of SVB deposits were above the $250,000 insurance limit. Uninsured. The FDIC took over the same day. The U.S. Treasury backstopped all deposits the following Monday, insured and uninsured alike. Because the alternative was contagion. Bank runs are the original system vulnerability. 400 years in and we are still patching it. The system is held together by the Federal Reserve as lender of last resort. When banks are in trouble, the Fed lends unlimited short-term cash using their assets as collateral. This backstop is why bank runs are rarer today than in the 1930s. The Fed also sets the federal funds rate, the rate banks charge each other for overnight loans. When the Fed raises rates, borrowing gets more expensive across the entire economy. When it cuts, credit expands. Every mortgage rate. Every credit card APR. Every business loan traces back to one committee meeting in Washington. The Federal Open Market Committee. 12 people setting the price of money for 330 million Americans. 8 meetings a year. Each decision moves trillions. Your bank does not have your money. It never did. That $1,000 deposit funds $10,000 in economic activity. That is the deal. More credit, more growth, more risk. The system works until confidence breaks. And when confidence breaks, 10 hours on Twitter can collapse a $209 billion bank. If this changed how you think about money, subscribe. New explainer every week: economics, AI, developer tools, no hype. Drop a comment. Do you think zero reserve requirements are a good idea or a ticking time bomb? I read every single one.